Hello, let's talk about the feasibility analysis assumptions. The feasibility analysis uses three calculations: the cost of equity, the cost of debt, and the weighted average cost of capital. The cost of equity is the return that the shareholders of a company require for an investment. Cash flow uses the capital asset pricing model to estimate this cost of equity, and it requires three inputs: the risk-free item, the beta, and the market risk premium. The risk-free asset is a measure of the return in a financial asset with the least amount of risk. Normally, investors use treasury bills or government bonds as a reference for the risk-free asset. In this example, we will assume that a treasury bill is currently returning 0.33%. The beta is the measure of the intrinsic risk of the company when compared to the market. So a beta above 1 means that a variation in the return of the company will be greater than those of the market. A beta under 1 means that the company will have lower volatility than the market. For non-public companies, it is not possible to calculate the beta, so it is common to use a proxy like listed companies of the same sector. In this example, we can assume that the betas of comparable companies is 0.47. The market risk premium corresponds to the difference between the average market return and the risk-free asset. For this example, let's consider an average market return of 5.85%, while we previously stated that the risk-free was 0.33%. This says that the market risk premium is 5.52%, based on these two previous parameters. We can now calculate our cost of equity. Next comes the cost of debt, which represents the cost of financing through external means. To represent the cost of debt, we could use the average interest rate of debt financing held by a company, an average of the interest costs, by dividing the interest costs by the debt of a particular year, the interest rate of the most relevant loan held by the company, or you can do a market research. For this example, we will assume the value of 4%. The effective cost of debt includes the tax shield. As for the weighted average cost of capital, you just need to insert the equity weight percentage. The remaining fields of the formula are calculated according to the previous information. The last element is the perpetuity growth. It is not mandatory that you fill this field. A perpetuity is advisable when in the presence of the following features: there is a foreseeable stability in the business and industry are in a mature state, and it is not expected to happen any significant growth, at least in the closer years, and it is not foreseeable a significant modification in either the technology, the industry, the regulation, or on any other feature that would significantly alter the production costs. For the example, we will leave the perpetuity growth in blank. Now that we have inserted all assumptions, click on Save and let's check the dashboard of our project. As you can see, we have all the assumptions in green. That means that there are no warnings that have been triggered. Let's scroll down. Now that the project is complete, we can check the graphs and reporting in order to check if everything is all right. And that's all. This is the last video tutorial about how to do a project in Cashflow app. Feel free to contact us in case of any doubt. And until next time.